It was a good day in markets across West Africa. Let's take you through some of the numbers, starting with the BRVM. The BRVM 10 index closed up about 0.9% to 229 points, while the composite index closed up 0.75% to 206 points in trading yesterday. The CFA currently trading at 501.05 to the US dollar. And moving on to Ghana, we did see the market move up ever so slightly to 1,904 points for the GSE composite, up about 0.2%, while the financial stock index was up 0.3% to 1,639 points. Year-to-date, that index is up 57%. The CD currently trading at 2.052. The US dollar, it's now down 7.3% for this year. And moving on to Nigeria, we did see the market extend recent gains to the 8th day. The NSE All-Share Index closing at 38,334 points, up just under 1%. We saw gainers include the likes of Dangote Cement, UTC, Flour Mills, and Dangote Sugar. We did see some muted response to some of the results we released yesterday. Nigerian breweries released pretty flat numbers, and likewise Unilever, we did see their share prices move down 3.5 and 0.7% respectively. And for Sterling Bank, that released much better numbers in terms of growth. PAT was up about 97%. That share price was only up about about 0.3%. Let's now move on to the fixed income market. In fixed income market, Treasury bill yields have fallen this week after year-on-year inflation fell to 8.4% in June from 9% in May. To get the latest on this market, we're joined by Yomi Balogun, a trader at Stanbic IBTC Global Market. Yomi, thank you very much for joining us. So maybe we should start with what we're seeing in the T-bill market. Like I mentioned, we're seeing yields fall back, and that suggests to me that we are seeing some demand come back to the market. Can you just talk us through what you're seeing in the T-bill space?
Yes, in the Treasury bills market, it's been quite an active week. With the release of the inflation figures, which brought inflation down to 8.4%, we've seen quite a lot of activity in this market, purchasing of T-bills. Another reason why there's been quite a lot of activity is because most of the feelers, the expectations for next week's MPC is that probably rates are going to be kept on hold, and that would mean that you wouldn't see a jump in interest rates after the MPC meeting. And
right, so you get the sense that sentiment has changed a little bit. At some point, some people are suggesting maybe there was a 30% probability that we'd see rates go up at the MPC next week. But given what we've seen recently, I think the Naira has stabilized a little bit, and there is more of a positive sentiment. Maybe not a bit too early for us to see some easing, but then perhaps we would see the MPC keep yields rates on hold. Do you share that sentiment?
Yes, definitely. Naira has been more or less stable in the past 2 weeks, and you know that usually when there's a lot of volatility in Naira, that is where we see the MPC coming up and tightening, and we see interest rates going up. But if it's been this stable, even though it's at a higher level than what it was about a month ago, but quite stable, I don't see the MPC tightening.
All right. If we move on to the bond market, very interesting what we saw this week. Can you just talk us through your view of the results of the bond auction that held this Wednesday? We did see the DMO sell the 2015 and 2030 bonds, yielding 3.45% for the 2015 and 13.79% for the 2030 bond. So was that in line with your expectations given the demand dynamics we've seen recently?
Well, actually, the result printed lower than most people expected, and I think more of a result of the level of subscription we saw at the auction. DMO offered 20 billion in 2015 and 35 billion in the 2030, and we saw the subscription level as high as about 135 billion. And so we saw the rates actually printing lower than what was expected.
Right. If we see the MPC, as widely expected, leave yields, or rather rates on hold at the meeting next week, what's your outlook for bond yields going forward?
Well, I think that would signal to offshore investors mainly that there's not likely to be an increase in the yields, and so at the present yields which we have, which are a bit attractive to them, you probably would have a situation where they would think of re-entering the market at these levels.
All right.